The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
This is America's Gold Authority podcast. My name is Mike Barnes. I am your host, and there have been some recent headlines about gold's volatility, which might be surprising because gold is often considered a safe haven. Well, are those headlines a little misleading? Let's go to our expert and find out. Philip Diehl, 35th Director of the United States Mint, President of U.S. Money Reserve. What have you thought about all of this movement with the price of gold, Philip?
Yeah, we've had some big movements here in the last week. I'm not really sweating over this. Over the last 60 days, we've had a $1,000 increase in gold prices, just unprecedented. And so you'd expect to have an adjustment in prices given this sort of enthusiasm. And so a $250 give back, that's what it's been in this adjustment out of that $1,000 increase in 60 days. That's not a surprise to me. And in fact, I think it's good news. I think we need to be looking for opportunities for buying gold. And those opportunities come when there is a price adjustment. And over the last 2 years of this rally, we haven't had very many. We've had only a few that have been in the neighborhood of $100 to $150. And so for one to come along that is $250, it's just a great opportunity to buy. I know people who just within the last couple of weeks have told me, darn it, I missed my opportunity to buy before this big rally. And they kind of kicked themselves because they didn't buy. Well, here's your opportunity. It's come back around. And so I think that's really how we need to be looking at it. Now, everybody asks the question of, is this the end of a rally or is it an adjustment that's going to continue in the rally? People scratch their heads and feel like there's no way to know how to answer that question. And that's simply not the case. You look for the fundamentals. What has been driving a rally? Have those fundamentals changed? And if so, how much have they changed? And the reality is here today is that none of the fundamentals that have been driving this rally for the last 2 years have changed. They're all in place. What we've seen here this week has been really nothing more than profit taking. People have ridden this $1,000 increase over 60 days, really almost a doubling in price over the last 2 years. And so they're seeing an opportunity to go ahead and book those profits. And that's what has happened, that inevitably when that kind of sales pressure comes, then you see a price decline. Those people are going to be coming back. And so I expect to see an inflow of into gold ETFs, into hard buying and a hard currency buying, physical gold. And in particular, one of the drivers that has been huge in this rally has been central banks. And they've been buying despite high prices. There had been a lot of talk that they would back off. And that's not the case. They buy for the long term. And they see the long-term opportunity. They buy for the same reasons that we urge our customers to buy. And I expect to see the central banks come in with these lower prices and really weigh in strong.
I've seen some headlines talking about the profit takers, the day traders, being the big reason why there was a drop in price within the last few days for the price of gold. But I think you definitely agree that things like interest rate cuts, inflation worries, and credit risks are a big reason why gold will continue to rise.
Yeah, that's right. We look at the mix of forces, and that's really what it is. If you read the newspaper articles, you'll see different forces cited as being the reason why gold is rising. And they're not wrong. Different forces are coming into the market at different times to drive these gold prices. But the big ones have been, from the very beginning, central bank buying, geopolitical uncertainty, and it's not just geopolitical uncertainty, it's outright warfare in Europe, spreading in Europe, not just in Ukraine, in the Middle East, and growing tensions with China. If you pay attention to the news, you see every other day a news story about the increase in the Chinese military capabilities. And that's no accident. They have set a timeline of 2027 for being able to take back Taiwan. That doesn't mean that they will actually attack Taiwan in 2027, but they plan to be ready to when the opportunity arises. Just in the last week, we've begun to see stories about increased credit risks. And some of that is centered around two automobile-related companies that have suddenly gone bankrupt. The surprises in their books about the kinds of companies who have loaned money to them, both private equity and banks, and the risk that those bankruptcies really, they themselves don't necessarily present, but the fear that there are others lurking out there just like them that threaten the banks. And that's been reinforced by two middle-sized banks this week that we saw really get into trouble, which reminds us of the mini banking crisis we had about 16, 18 months ago.
You know, as a former journalist, I know that reporters all the time are looking for headlines, something to talk about for the price of gold, and why is it going up or why could it be going down now? So they're looking for that big answer, but I think the biggest answer right now is that financial advisors are finally seeing that gold has gone up so much over the last 18, 24 months that they need to advise people to buy gold.
Yeah, that's exactly right. That's what's happening. For decades, we've seen financial advisors who have resisted talking about gold. Now, I understand some of that. There's a lot of hocus pocus, a lot of ideology, a lot of myth around gold. And financial advisors don't want to get into that mess. And also, a lot of them are not educated on gold by their companies. So if a customer brings up gold, then they kind of shy away from talking about it because they're not really informed like they are in other asset classes. Well, what has changed now is this 2-year rally has forced gold onto the table in those discussions. Clients are bringing that question in to their advisors, and they're insisting on discussions about that. And financial advisors have begun to respond. And we're seeing more and more top financial analysts and heads of major banks who are saying that, yes, gold now in this current new economic order, this new economic regime, has a crucial role in people's portfolios. In the past, you might have seen advice from these very same people of maybe have 5% of your portfolio in gold. That's not the case anymore. More typically, even the conservative ones are saying 10 to 15% of the portfolio ought to be in gold. And we saw the CIO of Morgan Stanley recently advised that the old 60-40 formula, 60% stocks, 40% bonds, needs to be changed to 60% stocks, 20% bonds, and 20% gold. And we're seeing some recommendations of as much as 25% of a portfolio ought to be allocated to gold. Now, there's no perfect number. It depends on all kinds of factors that apply to you, the individual investor, based on your assets, your risk averseness, your optimism or pessimism about the state of the world and the economy, and how close to, for example, you are to retirement. But gold is on the table, and it's on the table not just for your personal portfolio, but it's on the table as well for IRAs, for retirement funds. So, and we're seeing increasing interest in U.S. money reserve in incorporating gold, self-directed gold IRAs as part of a portfolio.
Yeah, it's such a great investment way to diversify for the long game, especially because I was told years ago that when you're investing your money for the long run, or especially a 401k or an IRA, you can't look at the stock market every day and get worried about it because it's a long-term investment. And the price of gold continues to go up and proves that it's a great long-term investment as well.
What's happened here in the last 2 years, and people are finding this is one of the reasons why gold is being put on the table by clients with their financial advisors. Gold has outperformed stocks, the S&P 500, over the last 2 years by a substantial margin. It's even outperformed over the last 2 years the so-called Magnificent Seven. Those are the stars, the technology stars that everybody has been so hot about. And gold has outperformed the Magnificent Seven. Gold has even outperformed Bitcoin this year by a factor of 2 to 1. And so we have this situation now under this new economic order that has developed over the last year and a half, in which gold is not only playing its traditional role as a safe haven investment, but it's also playing a very competitive role with the stars of the so-called risk-on assets. And so it's one of these unusual situations where you can have your cake and eat it too, where you have the safe haven in hard times if they come, and I believe they will come. I don't believe the stock market can maintain these incredibly high valuations. I think there's going to be a big adjustment in that. So gold is a safe haven to diversify a portfolio against that eventuality. But also, you do not give up returns if the economy remains strong, if the stock market remains strong. And we've seen that in the last 2 years. And I just ran the numbers yesterday, looking at how gold has performed against like 18 different asset classes, from U.S. stocks and U.S. Government bonds, private sector bonds, and foreign investments as well. And gold has been outperforming them all over the last 10 years.
Speaking of having your cake and eating it too, you have to be very excited with your history with following gold. The fact that there are some headlines and some financial institutions saying the gold prices could hit 5,000, maybe even 6,000 in the not so distant future.
Yeah, I'm in that school. I saw there was a major bank, may have been Goldman Sachs, I don't remember right now, that had projected $5,000 gold by the end of next year. They're not the only ones. There's a number of major banks and major advisories, advising firms that are likewise looking for gold in that $5,000 neighborhood by the end of next year, 2027. These projections, these forecasts have been proven to be wrong over and over again over the last 2 years. They've been too conservative. Those targets have been passed oftentimes in a matter of a few months after they've been issued. Personally, I'm looking at $5,000 gold by June of next year. So I'm confident that this rally is going to continue and will resume the pace that we saw over recent months.
We like your forecast. Philip Diehl, thank you so much as always for joining us today.
Thank you, Mike.
That is all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They will be happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.